You've been told the AI stock boom is the only game in town for 2025. You've seen the headlines, heard the hype. Technology, we were promised, was rewriting the rules of investing. But what if I told you an ancient asset, one left for dead by many modern strategists, quietly delivered almost 3 times the returns of the stock market this year? The results of the ultimate 2025 asset battle between gold and stocks are in. And the winner is not what you think. While everyone was chasing the next AI unicorn, this timeless store of value was leveraging a world in turmoil to stage one of the most incredible breakouts in financial history. The fight for the best investment of 2025 is over, and the winner is going to surprise you. Stay with me, because the numbers don't lie, and what they reveal about our global economy is something every single person needs to understand. For the better part of 2 years, the story was crystal clear. Artificial intelligence would power the next great bull market. And for a while, it did. We saw tech stocks surge to what felt like unsustainable highs, pulling the entire market up with them. The S&P 500 posted what looked like respectable gains, somewhere in the ballpark of 15 to 18% for the year. If you only read the headlines, you'd think everything was fantastic. You'd believe holding a simple index fund was the smartest, safest path to building wealth in 2025. But beneath the surface, the story was much, much darker. Those gains were built on a house of cards. The market was dangerously concentrated in a handful of mega-cap tech names, all riding the same wave of AI speculation. Valuations were stretched to historical highs, reminiscent of past bubbles that didn't end well for the average investor. At the same time, the world was becoming an increasingly unstable place. The engine of globalization began to sputter and reverse, with populist policies leading to a new era of protectionism. The United States administration introduced a series of targeted tariffs, threatening to ignite a full-blown trade war that could, according to some analysts, trigger a significant correction in the stock market. This isn't just theoretical. It creates real, tangible risk. In fact, an April 2025 IMF analysis showed that international military conflicts can slash stock returns in emerging markets by a staggering 5% per month. Think about that. While the market was celebrating AI, it was ignoring the geopolitical tinderbox it was sitting on. An increasingly fractured world, new and escalating conflicts, and the very real threat of global trade grinding to a halt. This was the problem. The stock market's cheerful facade was masking deep, systemic risks that left investors far more exposed than they realized. The AI boom wasn't a savior, it was a distraction. So what does this actually mean for your money? It means the game has fundamentally changed. Believing in the simple mantra of stocks always go up became a dangerous proposition in 2025. The agitation, the real anxiety, comes from understanding what's at stake. First, let's talk about the US dollar. For decades, it's been the world's undisputed reserve currency, the bedrock of the global financial system. But in 2025, that foundation began to crack. As trade frictions escalated and concerns over massive US fiscal deficits grew, the dollar took a serious hit, falling nearly 9% over the course of the year against a basket of other major currencies. When the dollar weakens, the purchasing power of every single dollar you hold, save, and invest erodes. It's a stealth tax on your wealth. Gold, priced in dollars, has an inverse relationship to this. A weaker dollar is a powerful tailwind for the price of gold, a theme we saw play out spectacularly this year. Second, the bond market, traditionally the safe harbor during stock market storms, failed to provide protection. With inflation proving difficult to stamp out and governments around the world issuing record amounts of debt, confidence in bonds eroded. When the so-called risk-free asset is no longer risk-free, where do you turn? Investors were caught in a trap. Stocks were volatile and overvalued, and the traditional alternative, bonds, were losing their safe haven appeal. This is the agitation. It's the feeling of being cornered, with fewer and fewer places to safely grow your capital. And finally, let's circle back to the stock market itself. The concentration risk was extreme. A handful of companies were responsible for the majority of the S&P 500's gains. This isn't a sign of a healthy, broad-based rally. It's a sign of a speculative frenzy. It means that if just one or two of those AI darlings were to stumble, they could bring the entire market down with them. Investors who were all in on stocks were unknowingly making a highly concentrated bet on a single sector, all while ignoring the flashing red lights from the global economy. The problem wasn't just that stocks might fall. The problem was that the entire system was becoming more fragile. The dollar was weakening, bonds were unreliable, and the stock market's strength was an illusion. The stakes were no longer about just missing out on gains. They were about protecting your principal from a series of interconnected and accelerating risks. So, in a world of overvalued stocks, unreliable bonds, a weakening dollar, and simmering geopolitical conflict, where did smart money find refuge and spectacular returns? It found it in the oldest, most reliable store of value in human history, gold. While the S&P 500 was delivering its 15 to 18% gain, gold was staging a historic breakout. As of mid-December 2025, the price of gold has surged by over 60%, crushing the returns of the stock market. It smashed through the $3,000 level in March, blew past $4,000 for the first time ever in October, and recently traded at astonishing levels above $4,300 per ounce. This wasn't a fluke. This was a rational response to the state of the world. Let's break down the three core reasons why gold didn't just win the 2025 asset battle. It dominated. First, and most importantly, geopolitical risk as rocket fuel. Gold thrives on uncertainty. It is the ultimate safe haven asset, and 2025 delivered uncertainty in spades. From ongoing conflicts in Europe to rising tensions in the Asia-Pacific and the implementation of protectionist trade tariffs, the global landscape grew more fractured and dangerous. As one geopolitical expert noted, we are living in a world where risks are accumulating and significantly reorganizing global structures. Investors, rightly spooked by the potential for these conflicts to disrupt supply chains, spike inflation, and crater economic growth, fled from paper assets and into the tangible safety of physical gold. This wasn't just fear-based buying. It was a strategic hedge against a world order that feels like it's coming apart at the seams. Gold has a low correlation with other asset classes, which means it acts as insurance during times of geopolitical stress and falling markets. In 2025, that insurance policy paid out, big time. Second, the great de-dollarization in the central bank buying spree. This is perhaps the most powerful and least understood part of the story. While retail investors were distracted by stocks, the world's central banks were quietly executing one of the biggest pivots in modern financial history. They were dumping US dollars and buying gold at a record-breaking pace. For years, central banks ran at a steady pace, but that all changed around 2022. We saw 3 consecutive years of buying that exceeded 1,000 tons. The pace in the third quarter of 2025 was relentless, with central banks continuing their record-breaking buying spree as part of a massive wave of overall institutional demand. Think about what this signals. These are the largest, most sophisticated financial institutions in the world. They are diversifying their reserves away from the US dollar, signaling a structural shift in the global monetary system. Countries like Poland, Brazil, and others in emerging markets are leading this charge, strategically increasing their gold holdings as a hedge against the very currency debasement and geopolitical risks we've discussed. This isn't a short-term trade. This is a long-term tectonic shift. This institutional demand creates a powerful structural bid under the gold price, providing a floor and fueling its upward momentum. And the third reason for gold's dominance? The monetary policy pivot. Gold is often called a barbarous relic because it pays no interest. This makes it sensitive to the actions of the Federal Reserve. When interest rates are high, holding gold has an opportunity cost. You could be earning a yield in a savings account or a bond. But when real interest rates fall, that opportunity cost disappears and gold becomes incredibly attractive. Throughout 2025, as signs of a cooling US labor market emerged and inflation, while sticky, showed signs of moderating, the market began to price in interest rate cuts from the Federal Reserve. This expectation of easier monetary policy put downward pressure on the US dollar and sent gold prices soaring. A weaker dollar makes gold cheaper for foreign buyers, increasing demand, while lower interest rates make the zero-yield yellow metal a far more competitive asset. The Fed's dovish pivot was the final piece of the puzzle, removing the last major headwind for gold and turning it into a powerful tailwind that propelled it to record highs. So there you have it, a perfect storm of geopolitical fear, a historic central bank pivot away from the dollar, and the promise of easier money from the Fed. This wasn't a speculative bubble. This was a fundamental repricing of gold for a new, more uncertain era. Now, before we get into the most important part, what this all means for your portfolio moving forward, if you're getting value from this deep dive, do me a favor and hit that subscribe button. We break down the complex world of finance every week to give you the clear, actionable insights you need to navigate these turbulent markets. Don't miss out. Okay, so gold was the undisputed champion of 2025. But this isn't just about declaring a winner. It's about empowering you with a framework to protect and grow your wealth in the years ahead. Declaring gold is better than stocks is too simplistic. The real lesson of 2025 is about balance, diversification, and understanding how different assets perform in different environments. Let's build your strategic toolkit. Gold versus stocks, the defensive lineman versus the star quarterback. Think of your portfolio like a sports team. Stocks, especially growth and tech stocks, are your star quarterback. They have the potential to score huge points and deliver spectacular growth. But they are also vulnerable to getting sacked. In 2025, the AI quarterback put up points, but the geopolitical and economic pressures were like a relentless defensive line, creating constant risk. Gold is your all-pro defensive lineman. It doesn't score touchdowns. It doesn't generate a dividend yield. Its job is to protect your portfolio. When the stock market gets hit, gold holds the line. Its low correlation to equities is its superpower. The lesson isn't to fire your quarterback, it's to make sure you have a world-class defense. Most analysts now suggest an allocation of 5% to 10% in gold to hedge a portfolio, with some arguing for as much as 15% in today's environment. Gold versus bonds, the inflation hedge. For 40 years, bonds were the go-to defensive asset, but 2025 may have shattered that illusion. With soaring government debt and persistent inflation, bonds offered meager returns while carrying significant risk. Gold, on the other hand, is a real asset. It's a store of value that can't be printed into oblivion by a central bank. As real yields fell in 2025, gold, the zero-yield asset, became king. While bonds are a promise to be paid back in a currency that is actively being devalued, gold is a hedge against that very debasement. In an era of high debt and fiscal irresponsibility, gold preserves purchasing power in a way that fixed income simply cannot. Gold versus Bitcoin, the stability showdown. Bitcoin is often called digital gold, and it did perform well in 2025, surging alongside gold as another safe haven alternative. But the two are fundamentally different beasts. Bitcoin is the high volatility, high risk newcomer. Gold is the time-tested, stable anchor. Gold's volatility is a fraction of Bitcoin's, making it far superior for true wealth preservation. While Bitcoin's value is driven by speculative adoption and network effects, gold's value is underpinned by thousands of years of history and massive physical demand from central banks, jewelers, and investors. Gold has near zero counterparty risk and doesn't face the same regulatory overhang as the crypto space. Both can have a place, but for pure, reliable portfolio insurance, gold's stability remains unmatched. How to add gold to your portfolio. So how do you actually get this protection? You have three main options. Physical gold. This means buying gold bars and coins. This gives you direct, tangible ownership completely outside the financial system. It's the ultimate insurance policy, but it comes with storage costs and security concerns. Gold ETFs. Exchange-traded funds like the Spider Gold Shares, GLD, or iShares Gold Trust, IAU, are incredibly simple. You can buy them in any brokerage account, and they track the price of gold directly. They are liquid and convenient, though they come with a small annual expense ratio. Gold mining stocks. This is a leverage play on the gold price. When gold prices rise, the profits of well-run mining companies can rise even faster. This offers much higher upside potential, but also comes with much higher risk. Mining stocks are still stocks. They are subject to company-specific issues like operational problems, management mistakes, and political risk in the countries where they operate. The right choice depends on your personal risk tolerance and goals. For most people, a combination of ETFs for liquidity and a small amount of physical gold for true disaster insurance offers a balanced approach. The story of 2025 wasn't about AI. It wasn't just about stocks versus gold. It was a wake-up call. It was a clear signal that the economic and geopolitical landscape has fundamentally shifted. The tailwinds of globalization and stable geopolitics that powered the stock market for decades are now headwinds. In this new environment, gold has reasserted its ancient power. Its incredible performance, more than doubling the returns of the stock market, wasn't an anomaly. It was a logical reaction to a world grappling with instability, currency debasement, and a historic pivot by the world's central banks. Looking ahead, major financial institutions like JP Morgan and Bank of America see this trend continuing, with some bullish forecasts making the case for gold to push toward $5,000 per ounce in the coming years. This doesn't mean you should sell all your stocks and go all in on gold. It means you need to be smarter. You need to be more resilient. It means understanding that a portfolio built for the last decade is not the right portfolio for the next one. The ultimate lesson from the 2025 asset battle is the timeless power of diversification. Gold proved it is no longer just a defensive asset, but a crucial component for any serious investor looking to navigate the uncertain waters ahead. Now I want to hear from you. How are you positioning your portfolio for 2026? Are you adding gold? Let me know your strategy in the comments below. And if you found this analysis valuable, please give this video a like, subscribe to the channel, and hit that notification bell so you never miss an update. Thanks for watching, and I'll see you in the next one.